The stock market is up. So why does your 401k feel worse? The strangest part is not that your 401k feels bad when the market is down. The strangest part is when the headlines are practically shouting that stocks are booming, indexes are hitting records, somebody on TV is smiling in front of a green chart, and then you log into your retirement account and somehow feel not broke, not ruined, just worse. Worse than you expected. Worse than the mood of the country. Worse than the story you were told. And that disconnect makes people feel crazy because the message is so simple. The stock market is up. Your retirement is invested in the stock market. Therefore, your retirement should feel up too. But that's not how the system actually works. What most people call the market is a headline. What you own inside a 401k is a product. And those are not the same thing. Behind the curtain, your 401k was never designed to make you feel rich. It was designed to keep you enrolled, keep you contributing, keep the employer compliant, keep the plan defensible, and keep the entire machine running without too many people panicking at once. That is a very different objective. The first trick is the language. When financial media says the market, they usually mean a handful of indexes. And even when they say it casually, they often mean the most photogenic part of the market. The part that makes for clean headlines. The part powered by the biggest companies, the biggest stories, the easiest narratives. A few giant winners can make the market sound like a party. But your 401k probably doesn't live at that party. Your 401k is usually spread across a menu. Large cap funds. International funds. Bonds. Maybe small caps. Maybe a target date fund wrapping all of it together. Maybe some cash-like allocation sitting there quietly. Maybe fees shaving a little off the top so gently you barely notice, which is exactly how those fees prefer to operate. So when the headline says the market is up, what it often means in practice is that a concentrated slice of stocks is doing incredibly well. And when your account says, that's nice. We're not built like that. The emotional result is brutal. Because it feels like you did the responsible thing and still somehow missed the upside. And in a way, you did. Not because you made some obvious mistake. Because the system put you inside a very different vehicle than the one being advertised to you in public. That's the second trick. A 401k is not really an investing experience. It's an employment benefit wrapped around an investing process. That sounds small. It's not. A brokerage account says, in effect, here's the market. Good luck. A 401k says, here is a controlled environment selected by committees, filtered through payroll, packaged for mass participation, and optimized so the average employee doesn't do anything too destructive. That is a totally different mindset. Inside a company, the people overseeing the 401k are not sitting in a room asking, how do we make everyone feel brilliant when tech is ripping? They're asking, how do we offer a menu that won't look reckless? How do we reduce legal risk? How do we create defaults people will actually stay in? How do we make sure the 58-year-old who never checks his account is not accidentally all in on something that can implode? The plan is built for the whole herd, not for your emotions on a Thursday afternoon. That's why the default option in many plans is some version of a target date fund, which sounds neutral, helpful even. Set it and forget it. Age appropriate, professionally managed. And to be fair, for a lot of people, that is better than doing nothing. But here's the part no one really says out loud. Those funds are not trying to win the same race the headlines are describing. They're trying to manage a different problem. They are built around the fear that one day you will be older, more fragile, closer to needing the money, and less able to recover from a violent drop. So they don't just chase whatever is hottest. They mix in assets that are supposed to smooth the ride over time. Bonds. International exposure. Different market segments. A glide path that gradually gets more conservative whether you feel like it or not. That sounds prudent because it is prudent. It also means there will be long stretches where the news says stocks are flying while your account behaves like a cautious adult standing in the corner holding everybody's car keys. And that gap is infuriating if nobody explains it to you properly. Because from the outside, it feels like underperformance. From the inside, it's operating as designed. That's the hidden mechanism. The design goal is not maximum excitement. The design goal is survivability. And survivability is emotionally unsatisfying in bull markets. There's another layer people miss. Most workers don't experience the market as a lump sum. They experience it through payroll deductions. That matters more than people think. If you invest a big amount before a long run up, you feel smart fast. If you invest bit by bit every 2 weeks, through rallies and dips and corrections and fake recoveries and inflation scares and ugly quarters, your emotional experience is completely different. You are not watching one line go up. You are constantly dropping fresh money into whatever the market happens to be doing at that moment. So imagine the sequence. The headlines are strong. You keep contributing. Then the account dips. Then it recovers, but not in the parts you own the most. Then your newest contributions are still too recent to have compounded into anything emotionally impressive. Then you look again after taxes, after rent, after groceries, after life has gotten more expensive, and the balance may be technically higher than it used to be, but it doesn't feel higher. That word is important. Feel. Because retirement accounts are one of the purest places where mathematical progress and emotional progress split apart. You can be ahead on paper and behind in your body. The plan providers know this, by the way. They know most participants are not reading fund fact sheets. They're not benchmarking carefully. They're not saying, yes, my diversified risk-adjusted outcome is proceeding according to long-horizon retirement planning assumptions. They're opening an app in a stress state and asking one primitive question. Why doesn't this feel better? And the real answer is because the system doesn't report success the way humans experience success. Humans experience success through contrast, through acceleration, through visible reward. The 401k gives you delayed, abstract, diluted feedback. It gives you long-term virtue with short-term ambiguity. That's hard enough already. Then the media adds gasoline. Because media talks in symbols. Your plan talks in allocations. Media says, the Dow is up, the S&P is up, investors are optimistic, markets celebrate cooling inflation, Wall Street rallies. None of that tells you what happened to the exact funds inside your plan. None of that tells you whether your account is heavy in bonds because you're 45 and defaulted into a target date fund 10 years ago. None of that tells you whether your international allocation went nowhere while a few giant US names carried the entire mood of the market on their backs. None of that tells you whether fees, fund structure, contribution timing, or plain old diversification muted your upside. So you keep hearing the national story and comparing it to your personal statement. And your statement loses. Not only financially sometimes. Psychologically. Narratively. It makes you feel like everyone else is getting the version of capitalism with fireworks, and you got the office edition. Which, to be blunt, is not entirely wrong. The 401k is the office edition. It is the institutional version of investing. The domesticated version. The HR-approved version. The version built to function at scale for millions of people who are busy, distracted, risk-averse, undereducated about finance, and one panic away from sabotaging themselves. That doesn't mean it's evil. It means it has priorities. And once you see those priorities, the weird feeling starts to make sense. Employers want participation rates to be high because retirement readiness is good for the workforce and good optics matter. They want defaults that won't generate disaster stories. They want vendors that can explain themselves in clean, defensible language. They want the menu broad enough to look responsible, but not so wild that employees can blow themselves up and come back angry. Record keepers want assets to stay put. Advisors want plans that can survive scrutiny. Fund companies want to be included in default architectures that capture long-term contributions automatically. Everyone in the system benefits when you remain calm, keep contributing, and don't demand that your account reflect every exciting move in the stock market in real time. That's the internal logic. Stability first. Excitement never. And if you're younger, there's an extra insult hidden inside that logic. You're told youth is your advantage. Time horizon, compounding, risk capacity. All true. But your actual lived experience of youth inside a 401k often feels terrible because your balance is still small enough that progress looks unimpressive, while your contributions feel expensive enough to hurt. So you sacrifice in the present for a future number that barely moves in a way your nervous system can respect. You give up spending power now. You accept uncertainty now. You watch headlines celebrate gains now. And then your own account gives you a result that feels suspiciously average. That's an emotional tax no one puts in the brochure. Take a simple example. Two people here, the market is up 20%. One has a concentrated portfolio of whatever dominated the rally. He feels like a genius, even if it was mostly luck. The other is in a standard workplace retirement setup. Part of her money is in US stocks, part in international, part in bonds, part recently contributed, part still too small to create dramatic movement. She may be doing the more durable thing. She may be setting herself up better for a life, not a season. But emotionally, she feels left behind. And that feeling can be dangerous, because it tempts people into the worst move at exactly the wrong moment, using a long-term retirement system to chase a short-term emotional benchmark. That is one of the least discussed tensions in personal finance. People don't compare their 401k to their plan. They compare it to the loudest story in the room. That story is almost never calibrated to their actual portfolio. It's like being on a commercial flight and getting angry because a fighter jet is moving faster. The comparison is vivid. It is also useless. But here's where the insider view gets even sharper. The system quietly depends on that confusion. Not in some cartoon villain way. In a structural way. If people fully understood that a 401k is a conservative, committee-shaped, behavior-managed retirement conveyor belt, they might stop expecting it to feel exciting. That would be healthy. But it would also expose how much of modern investing culture is built on headline theater. And theater keeps attention. Attention keeps people engaged. Engagement keeps products sticky. So the public conversation stays blurry. You hear broad market optimism. You hear simple slogans. You hear just invest and time in the market beats timing the market, which are not wrong, but they are incomplete in a way that matters. Because people are not only trying to be right eventually, they're trying not to lose faith along the way. That's the real battle. A retirement system can be mathematically sound and still psychologically alienating. It can be the correct machine and still feel like a betrayal. Especially when prices have risen everywhere else in your life. This is the part almost nobody talks about honestly enough. Your 401k does not exist in a vacuum. You don't judge it against zero. You judge it against what your money used to buy, what your paycheck used to feel like, what your rent used to be, what your groceries used to cost, how far your salary stretches, how old you are now, and how much time you think you have left. So even if the account balance is higher, the emotional translation may be lower. Because the number grew, but your sense of security didn't. And security is what people thought they were buying. That's why the title question lands so hard. The stock market is up. So why does your 401k feel worse? Because the feeling is not irrational. It's diagnostic. It's telling you that the public scoreboard and your private reality are measuring different games. One measures spectacle. The other measures slow endurance. One is optimized for headlines. The other is optimized for institutional acceptability. One rewards concentration in the winners of the moment. The other often spreads risk so widely that success arrives looking strangely muted. And once you understand that, something important happens. You stop interpreting the discomfort as proof that you're failing. Maybe the account feels worse not because it's broken, but because you finally noticed what it actually is. It's not a front row seat to the market's best night. It's a payroll-fed, professionally constrained, behaviorally engineered holding system meant to carry ordinary people through decades without requiring them to become brilliant. That is useful. It is also deeply unromantic. And unromantic systems are hard to love in an age of instant comparison. So if your 401k feels worse while the stock market is supposedly up, don't start with self-blame. Start with translation. Ask what the market actually means in the sentence you just heard. Ask what you actually own. Ask what your plan is designed to do. Ask whose incentives shaped the menu. Ask whether you are comparing a retirement system to a headline machine. Because once those questions are on the table, the emotional fog starts to clear. You may still not like the feeling, but at least now you know where it comes from. And that matters because confusion is expensive. It makes people chase, panic, stop contributing, or demand a level of emotional gratification that retirement systems were never built to provide. The truth behind the curtain is less glamorous and more useful. Your 401k is not there to make you feel the full thrill of a rising market. It is there to keep you in the game long enough that the future might still work. And those are not the same promise. The market sells the dream in bright lights. Your 401k does its job in fluorescent lighting. That's why one looks richer on camera. And that's why the other feels worse.